So here we are again. I'm Oren Klaff. This is another episode of Done Deal, and I have a terrific guest today, Jeremy Glaser from Mintz Levin, and he is a partner at Mintz Levin and the co-chair, make sure I get this right,
the Emerging Companies and Venture Capital Practice.
Emerging Companies and Venture Capital Practice. And the reason that I'm very interested to talk to you all the time, but especially today, is because your daily grind is working on the financing of entrepreneurial and early stage companies. For the benefit of the record, how many have you worked on? 10, 100?
Oh my gosh, it would be hard to even come up with the numbers. So I've been basically working with early stage companies, helping them raise money for 30 years. It's got to be in the hundreds as far as angel financings, venture financings, taking companies public, all types of finance transactions.
Okay, so there's a couple ways that you start a company, especially if it's a capital efficient company. So you're entrepreneurial, you put in some of your own money or some of your friends and family money, you built something, whether it's a medical device, a software product, a piece of intellectual property, and then you start going, aha, the money that I have is not enough money to make this a great company. I need more money. So now I have to go out and talk to other people about giving me money.
Correct.
Right? So you go to the internet and you type in some stuff around the space that you're in and you see all these amazing financings. Acme company, this company that has a worse product than me, raised $10 million. This crappy company that doesn't do anything close to what I do raised $15 million. These guys who I know and are complete idiots raised $2 million. Somebody out there should just give me $10 million without much effort. So that's what entrepreneurs tend to think.
Okay, well.
In my experience.
Okay.
Or more sophisticated ones say, hey, we've built a prototype, we've got to a beta, we now need to go out to investors and find some additional capital. So you've seen thousands of situations through the kinds of things we're talking about.
Absolutely, everything from somebody walking in the door with a PowerPoint and an idea and saying, hey, we think this is worth $10 million, how do we raise money for this? Through significant public companies out raising hundreds of millions of dollars in public finance.
So are there general rules that make a deal or a company or a project financeable versus not financeable? Where do you see the winners, and I call the winners somebody who goes to market and in a period of 90 to 120 days comes back with the money they need for the company versus guys who are spending a year or more looking. So what's the difference?
Sure.
Are there takeaways from the work?
Sure. So there's a lot of things. There's obviously substantive issues around what the product is, right? And that is what is being financed in this current environment, what's hot, right? So if you're in a hot space, it dramatically increases your chances of getting funded, whether that's from angel financing sources or from venture capital financing sources. So obviously the substance of what you're doing really matters. But even if you have good substance, the presentation can really matter as well. And so one of the things I see, and unfortunately I see this all the time, is that entrepreneurs are fundamentally about their technology, right? They're in love with the new product, the new mobile app, the new cure for cancer that they're working on, and it makes sense. They devoted their lives to this, it's their idea, it's their baby. And the challenge is that they get so caught up in describing the technology that they forget that while the investors are certainly interested in the technology because that's how they're going to make money, well, it's what I just said. That's how they're going to make money. And so what I see most often, probably the most common sort of mistake, is not remembering that the investor is focused on one thing. They're putting money into your company so they get more money back. And so it's all about the investment strategy, it's all about revenue, and unfortunately a lot of entrepreneurs don't cover that in whether it's their PowerPoint or their initial communication with potential investors.
So, that tends to be my experience. People, entrepreneurs and companies are so excited about their idea, the PR that their idea is getting, the customers that are coming in, and all the attention they're getting. And they don't focus on the fundamentals that investors want to hear. And I find like that's what gives a space for you and me and intermediaries to make money and have jobs in this world, is that investors and entrepreneurs or company management don't speak the same language.
I completely agree. And again, I think it's just a matter of focus, right? You always want to remember when you're reaching out to somebody, you want to be thinking about what do they want? What are their concerns? What are they after? And not to focus on yourself. It's even, sort of a basic negotiation strategy you probably know. I negotiate deals for a living. And I'm always asking myself, what does that person want? Why are they asking this question? What is it that they're trying to achieve? And then trying to answer that in what I'm presenting to them. And unfortunately, again, I think, entrepreneurs, I love them, right? They're so excited about their product, they're so excited about changing the world that they fail to realize that investor, maybe isn't as interested in changing the world as they are. I mean, don't get me wrong, some are. They love technology, they want to see technology advance. But they forget that an investor has a fund, they have investors that they have to report to. They're focusing on their need to make returns in that fund so they can raise the next fund. They're focused on what their business is about. And so you need to talk to their business, you need to talk to their business objectives. And I think that's really important to be attractive to specifically professional investors.
So what's wrong with this statement? For an early stage company that doesn't yet have profits, is still funding losses because they're building product and growing, the number one source of the determinant of success in getting a round of investment is creating a lot of demand.
I totally agree. Whenever people talk about valuation, I always sort of laugh, and I just tell them a simple story, right? If you're selling your house, are you going to get a higher price if you have one buyer or three? It's the same in the finance world, absolutely.
So, for me, that is a huge takeaway. Our competitors raised $10 million. We're working with a company now, their competitor just raised $150 million, and they're a small company. And so they're saying that's not fair, or their stuff isn't as good as us. None of that matters. You can't defend your financing or defend your price. You have to create a lot of demand for it, and then you can choose the right person. So
absolutely, Oren. So I tell clients that sometimes they go into these meetings with investors and they have this mindset of my company's worth $10 million, and they have to say that out loud, and they sort of push it initially, and the net result is the investor says, well, I don't think it is, and I'm not interested in talking to you, and they lose the opportunity. And what I try to impress upon them is you don't need to be talking about valuation in those meetings. What you need to do is get these guys sold on how you're going to make them a lot of money, and then you get a term sheet. And if you get a term sheet, guess what? Now you're in the driver's seat.
Yeah.
As opposed to when you're trying to get the term sheet, they're in the driver's seat. Get the term sheet. And so what if they tell you your company's worth $2 million? You know what you can do? You can say no thank you and rip it up and put it in the trash and walk away. You don't have to take it. But if you get that term sheet, then it gets exciting, right? Because now, obviously, carefully and making sure you're in compliance with all confidentiality agreements, but you can start whispering out to the world, we have a term sheet. And guess what? One term sheet begets a second term sheet, begets a third term sheet, and you start to create that competition.
So maybe a second takeaway is a term sheet is a center of gravity for your deal. And whatever it is, anchor with that and try and build on it with additional offers.
I agree. I couldn't agree with you more. I think it's really important to generate excitement, to get multiple investors coming to the table. It absolutely drives value.
Okay. A firm comes in and they want your help to meet the Kleiner and the Sequoia and the A16 and the 50 other firms that you know and have relationships with. Mm-hmm. What makes a deal high enough quality and interesting enough for you to be willing to refer it on? And I know from working with you, you sort of have three levels of working with someone. One is, hey, I'd be glad to refer this to someone with an email intro. I will send out an intro. Number two is, we know people at these firms. Here's a list of people we know. You might want to reach out to them. And I'm busy, I can't return your email right now. How do I get in each of those three categories with you?
Yeah, sure. Well, and, given my business and given a lot, I'm making a lot of bets on companies with my time, I really do look at deals very much like a venture capitalist does. So when I see a term sheet or
can we just pause on that and make that as a third takeaway, right? So intermediaries, an investment bank, a lawyer looks at your deal the same way that they're a proxy for the investor.
Yes, I think
right. So if you're not getting traction with lawyers like Jeremy, then you're definitely not going to get traction with venture groups, and they're going to be much harder to reach. So use these proxies as good feedback for what you have. Sorry, I interrupted, but I thought that was a huge takeaway.
I agree. I mean, I think we've dealt with venture capital funds, with angels in so many ways on so many deals that we make it our business to understand what they're looking for. So we try to think like them. So when I see a deal, I look at it like I'm a venture capitalist. I ask myself, Is this a big enough opportunity? Can this become not necessarily $1 billion company? I know people are focused on unicorns today, and while that sounds wonderful, there's not going to be that many $1 billion companies. But can it become a $250, $500 million company? Can it get to revenue of 50 and maybe $100 million? Can I see that kind of a ramp? So I'm looking for the industry. I'm definitely looking at management. I want to, if I can, if the person has had success in prior deals, that's an absolute sign to me that they're going to be fundable. And there's like other things I can go down the checklist, but in general, it's really focusing on, is this a hot space? Is this something that can really grow big? Because VCs, their returns require companies to get very large. You might have a great business that'll be a wonderful lifestyle business and might make you very wealthy, pulling down $1 million or $2 million a year, in profits out of the business. But that's still not a venture backable business. The business needs to be able to show that it has the ability to really ramp and get into that $50, $100 million revenue with some significant cash flows. So it could either be a big M&A exit, a sale, or potentially go public. So that's what I look for, and then based on that, I'll then make the decision, okay, am I willing to put my name and my firm's name and our reputation on the line, which is really what we do every time, Oren. When we send that business plan off to a venture capitalist, it's really saying, hey, look, I know what you're looking for. I've looked at this, I've vetted it, I think this is a good fit for you. And if you abuse that, suddenly you're going to find you're not getting responses or returns, and so you're really thoughtful and careful about where you send those business plans or exec summary.
Okay, so what I look for in the same line of conversation is a quick synopsis on the stage of deal and where the finance is. So sort of switching the amount of time on what it is from 90% to 10%, and focusing 90% on what has happened so far and how much money has been raised, what's on the cap table, who the investors are, how much does current management own. As you said, I think, what's the background of management? Are there any customers? Where's the product? What's the stage of deal? So I guess I'm leading to my next question is, what do you do with tweeners, right? So Silicon Valley and the New York and Boston venture or investing scene is so, I feel like, has such a gravitational focus on what is a seed round, what is an A round, what is a B round, and what is a C round.
And it's all changed. In fact, those definitions have changed in the last 7-8 years.
Great. You would know better than I. Let's describe what today an A round is and a B round. And I think I learned from you, you can call these GG, FF, DD rounds. They don't have to be A and B, but it's a good nomenclature. So what would be something that people classically think about as an A, classically think about a B, and then where I'm going is, what do you do if you're stuck in between an A and a B?
Sure.
Right, where do you go with that deal?
Sure. So I think it's useful to sort of provide a little bit of historical perspective. I've been, again, doing venture deals since the mid-'80s, and so I've really seen it dramatically change. And when I first started out, an A round was literally the seed round. I mean, that was the first money coming in. You could either be at beta or even before beta. I mean, certainly during the dot-com era, we were seeing A rounds that were PowerPoints and nothing built and nothing even operational.
Yeah.
That is not the case anymore. If you look at the statistics, venture capital as a class of investments has moved much later stage. And so an A round with a venture capitalist is now what we used to call the B round. What do I mean by that? The B round was when you already had the product, you had some customers, you had revenue, and you were starting to see some ramp. Yeah. One of my favorite terms that the VCs use, and I love it, is the dogs are eating the dog food. That's when the dogs are eating the dog food, you're ready for the B round. Well, that's now the A round.
Yeah.
Everything's moved a little bit later.
Because it's easier to iterate, to build a product and have remote teams and have all kinds of plugins. And so for $25,000 or $50,000, you should be able to build a working product that can get a customer.
I think that's part of it. Okay. I think it's certainly that there's with the changes in technology and certainly with software companies and mobile app companies, you don't need as much money to get to that point. But I think it's also just a a change in the nature of the investors investing in the venture capital space. I don't think it's as patient money as it used to be. I think VCs used to go in really understanding that they were going to be building a company, that it was going to take 7, 8, 10 years to build that company to an exit. I don't believe that's really, and again, there's exceptions, but in general, that's not the view anymore. Now they're looking more for that 3 to 5 year exit if they can. Exits have gotten longer. It's still sometimes average 7 or 8 years, but that's not what they really are looking for. I think they've realized that the failure rate of earlier stage companies is something that they'd rather avoid. Let somebody else
eat the failures.
Fund that, and then they can pick them up once there's a lot more assurance that the product works, that there's real demand. They're not guessing. And then I think also, and maybe it just happened just because of the timing of the '08 crash. But I think as the VCs sort of pulled back from the market and the number of venture funds and venture money really dramatically reduced, we saw wealthy individuals step in to fill that gap. And so I think the whole market's evolved. There's now these what we call super angels, right? Very wealthy people who really are acting like the early stage, seed stage VCs, the role they used to play. Yeah. And they get those companies now to that point where they're ready for what's now the A round with the venture capital firm.
If I'm hearing this, the A round is no longer we have an idea, we're exploring it, we put stuff together. That's we have a business, and that business has clear evidence that it's working.
Correct, and really the nomenclature now that we use for, we have an idea, let's see if there's something there. Yeah. That's what we now call sort of a series seed or a seed round as opposed to an A round.
Okay, so seed A, and then let's define a B.
So B is really now growth, right? That's growth stage financing, again, which used to be the C round and above, right, in the old days, but now the B round is growth. That's where you're ramping, you're building sales, you're building marketing, you're dramatically increasing production if you have something that you're actually making, a piece of hardware. So that's really B round and beyond.
So criticize this description of a B round, because I maybe have an oversimplistic. You are in thousands of companies, and I'm in tens of companies doing this. A B round is, hey, Mr. Investor, we have a black box. On the black box is a blue button. Every time we hit that blue button, 2 marbles come out. We want to hit that blue button as many times as humanly possible during the course of a day. We need more people, we need more robots, we need more machines to hit this blue button more often so we can get more marbles out the other side. Is that a fair?
I think that's a great, I think that's a really good description, yep.
Okay.
The replicable model.
I'm glad you said that, because I've been telling that to people, and I really don't need on camera for somebody who does this thousands of times to say that's wrong. So everyone that I've said that to, that still remains correct. You don't have to revise your thing. All right, so what do we do with tweeners, right? So the reason I say that, I find like most of these venture firms that we've mentioned here and all the other 350 firms and databases and things like that view A very classically, as you've described it, and view B very classically. So what if we've taken some A money, we put a product in the market, but it's not working. Sometimes we hit the blue button on the side of the box and 2 red marbles come out. Other times we hit the blue button and nothing comes out. Other times we hit it and a can of warm Gatorade comes out. Other times we hit it and an old shoe comes out, right? And so it's not a predictable black box.
Sure.
What do we do with that company? We just give up and close it?
Well, I mean, look, so it depends on how unpredictable it is, right? The answer is sometimes yes. I mean, sometimes
you're making some people cry.
Sometimes the VCs would look at that and say, okay, it didn't work, time to move on. We've got to focus our energy on the winners. But in reality, they usually don't give up quite that quickly. They're usually pretty committed to try to morph the company to the next level and try to see if they can find a way for it to work. And so you could do multiple A rounds. They may not be called A, they might call them A prime. They might even call them the B round just because they want to give the impression to the potential new investors that things are advancing, right? We're doing the B round, right? So again, I don't know that the nomenclature necessarily matters. It's really a function of, can you still get funded when you've got the product going, you think it's all working, you go out in the market, and like you said, you're getting some it's not predictable. It's not necessarily ready to be replicated. I don't think that means it's the death knell, right?
But But I would put pressure on that, because I feel like in the Valley, there's A and there's B. B is it's working. A is there's a product and a team, and the pricing on A, let's just pick, is $10 million, and the pricing on B is
25 plus,
25 to 40, right? And so if you've got it,
more if you're, if you're one of those hot companies.
You built some people, you've got it working. Yeah, an old shoe comes out on a beer can, but lots of time marbles come out. It's sort of working, and you go, I'm not willing to take a $10 million price, right?
Yep.
We're not worth 25, but I'm not willing, and we've been doing this for 3 years. We were at $10 million 3 years ago. We've got customers, we have product. Inc. magazine did an article on us, right? Michelle Obama tweeted about us, whatever it is. And so we're not going to take a $10 million price anymore for all that. I mean, that's their thinking.
I know.
So where do they go?
Well, I'm smiling because I've seen that thinking, and that's not good thinking.
Okay.
I think unfortunately the mistake that entrepreneurs make is that they get fixated on valuation as opposed to they should be fixated on creating value. That if the valuation hasn't advanced, you really shouldn't be concerned about that. What you should be concerned about is, do we have the pieces in place, which includes being properly capitalized to grow the business, to create a much bigger company down the road? Because the reality is, you might get a little more dilution because the valuation is not as high as you wanted on that raise. But if the company is worth 10 times more 5 years from now, wasn't that a good decision to take that money and take some dilution as opposed to not taking the money because you didn't want to reduce your ownership? And the reality is, if your ownership has been reduced and the business is doing well and the investors are all excited and happy, guess what? They'll re-up your team, they'll re-up you with options, they'll restore you if your ownership is really not big enough to sort of give you the rewards for the growth. So I think it's a really bad idea for entrepreneurs to get caught up on, am I getting the right valuation? And I think it's a lot more important to focus on the things they talked about. Do I have the right investor? Do I have the right team? Am I properly capitalized to grow this business so they can look forward and say, okay, I see where I can get to a sustainable business with this amount of capital, and valuation will take care of itself.
Okay, that's fair. I've invented a company. It takes old coffee grounds, Pepsi, and you put it in the top of the machine, and you turn the crank, and titanium ball bearings come out the bottom, and then those can be sold at a 190,000% markup from what you get.
Can I invest?
Coffee grinds. Yes, you can invest. Lots of people want to invest.
Sure.
Right. When you invest, or a venture firm investor, I'm going to probably get a board member. At least one. How do I get self-determinism so I don't get a 27-year-old MBA from, I know you graduated from Harvard, so I don't want to malign Harvard, but let's malign Stanford. Okay? How do I know that I don't get a 27-year-old MBA from the University of Delaware who's going to sit on my board, who's never run a company, doesn't know anything about ball bearings, is familiar with finance from his finance classes at the University of Delaware, and 3.5 years ago was a prominent member of a fraternity.
Yes. I wish I could tell you how to avoid that. So the reality is that as the VC funds have gotten larger and they've got a lot more investments, and even though they've added more partners, the partners are sitting on a lot more boards than they used to sit on. And it really makes it difficult for them to be as actively involved as certainly they were in the 80s when I first started doing this business. The partner at the venture capital fund had a relatively small number of investments. That partner was at the meetings. That partner was intimately involved in strategy, in the product, in coaching the CEO, right? And there's still exceptions. There are still the funds that will do that. But the reality is, as you told that story, I started to smile, and without using any names of venture funds, because I don't want to malign any venture fund, I think this is an industry issue. The company that I was actually a member of the executive team on during the .com era, we had that problem. We had some big name VCs around the table and on the board, and when those big name VCs showed up at the board meetings, it was wonderful. But very often they would go ahead and have a proxy show up,
right.
And that proxy tended to be the young, inexperienced MBA.
And I love it when he says young, inexperienced MBA, he's pointing our last guest, the Special Forces interrogator, would have said, as Jeremy's going, the young, inexperienced MBA without any personal knowledge of it. No. So, sorry.
Exactly.
That's fine. I can take that as a personal insult. No problem.
Not intended.
Okay.
No. But that is real. It is a real challenge,
Yeah.
right? Because they're going to manage you based on financial metrics. They're not going to manage you based upon a deep understanding of how a business is built
Yeah.
and the challenges and when things go wrong, which they will.
Yeah.
I'm not saying they might. They will. I cannot think of any early stage client I've worked with in 30 years where things did not go wrong.
Right.
And when things go wrong, that's when you want to make sure you have the experienced people who don't panic, who can see the end of the tunnel, and are not just applying financial metrics to you.
I think this is a great 4th or 7th or 11th takeaway for me. And am I summarizing this right? I want not to maximize price, not to take the most amount of money or get the highest amount of PR from a great firm. It is finding someone who I believe, when the situation in my company goes pear-shaped, to put it nicely, won't put a boot on my neck based on the terms in the contract, because the terms will be there. It is somebody who will step in and say, like that photo they have in restrooms all over the world where you know, footprints. You know, I looked back over my shoulder and saw only one set of footprints, and the Lord said, I was still with you. That was me carrying you. You know?
Right.
So
right.
it's that finding that investor when things go wrong in pear shape will step in and not say, I've got contracts, I've got agreements. Jeremy got me some great terms in this deal. I'm putting my boot on your neck and I'm taking more of the company, or I'm going to take over more of the board. It's somebody who says, look, we got some problems. Let's write a check. Let's take a little bit more time and let's do this together. One set of footprints. Is that fair? Am I wrong?
Completely agree with you. That is so important. And unfortunately, in the current economic environment, particularly up in Silicon Valley, you know, with the unicorn world, unfortunately, there's been way too much focus on valuation. And you look at these companies that are not necessarily focusing on things like terms and the nature of the investor and the alignment of that investor's interest with theirs. They're just focusing on, hey, we got to be $1 billion market cap or a pre-money valuation so we can be part of the unicorn club because that gets us all this marketing and PR. And you know, not to be sort of a naysayer, but that reminds me a lot of the dot-com era, that 1998 you know, early 2000 era, where everybody thought an IPO was a branding event. An IPO is not a branding event. An IPO is supposed to finance the company for future growth and to provide liquidity for your team that have been slaving away to build a great company and your investors. It's not a branding event. So unfortunately, I think the same language around these $1 billion unicorn market caps, you know, it's what do they say that, you know, history doesn't repeat itself, but it rhymes. It's rhyming.
Okay. All right. Thank you so much for coming here. You had lots of uses for the time. You could have worked on a client, started a company, raised some money, build somebody for something, and you spend it with the time here with us, so I really appreciate it.
I'm happy to do it, Oren.
Okay,
Thank you.
Great. So this is this week's Done Deal. Jeremy Glaser at Mintz Levin, an incredible lawyer with amazing perspective on venture capital and getting financings done. And we will see you here next week with another something.